Today I'm going to discuss with the managerial accounting. So an introduction to managerial accounting. Chapter one. So in this case, what I'm going to explain you about first of all that what are the learning objective of today's lecture. So understand the basics of managerial accounting, understand the role of globalization, and learn a business model in influencing the managerial accounting, understand the impact of professional responsibilities. Okay, so managerial accounting, and first of all start with the management cycle. So what is the management cycle here? So in this case, we can see the three things which is very important. That is the planning. Then once the planning is done, we need to implement whatever that we have planned. Once the implementation work is done, we need to see what is the result, which is in the form of outcome that we will see. So the planning, the implementation, and outcome that we should know. And if we talk about the management accounting and management, what is the management accounting? So management accounting, that reports for the internal use by the managers, right? But it is totally different from the financial accounting. And the financial accounting reports are prepared for external users, such as bankers, stakeholders, and analysts, creditors, suppliers, our customers. So the financial accounting is not for the internal purpose, but managerial accounting is for the external use by the managers for taking some decisions. Now, if we say that before making like the planning and implementations and outcome, the four things, all these three things, that if we see from the bigger point of view, that we need to see that what is the vision of the organization, what is the mission, objective, and strategies of the organizations. That by considering all these four factors, main four factors, uh, then we consider that managerial accounting and financial accounting both are very important for any organization, in which that we make some planning, controlling, and financial reports that we prepare. So in the planning, so planning of the budgets. Then if we talk about the control, so we want to control something, right? So control in the controlling the cost and profitability reports, variance and analysis report, and balanced score chart will be prepared. Then the balance sheet, income statement, and statement of cash flow, that also can be seen in the financial reports. Now, if we talk about the strategies, so what is the strategy? Strategy is the general direction in which an organization plans to move to achieve its goals and objectives. So that is the strategies. Strategy is also just like a planning, right? So what are the things that we will do? Some of the activities that we plan, that we think like these are the activities that we need to do in the organizations, that is known as strategies. Now if we talk about planning, selecting a course of action and specifying how the action will be implemented. uh, Whatever the actions that we will make a strategy. Now after making the strategies, now those activities that will be implemented in the form of actions. Then why these actions to be implemented? The reason being is to achieve the goals and objective of the company. uh, I'm going to give one example of managerial accounting in planning. So in planning, what we do: budgeting. uh, Budgeting means like it's related to, for example, we have a limited budget, like let's say like a $100,000 that we have for the production process in our company. And within that $100,000 that we need to create a budget in such a way that we will be able to create product, or that we want to get the product from outsider parties or suppliers. In the planning, that not only the budgeting is important, but also the forecasting. Forecasting is like we are just estimating for the future, not for the present. That is also comes under the planning. So next is the performance. So performing what if analysis. So what is the meaning of what if? What if means just which is not clear, which is uh, not certain, mean contingent. So in the planning, that we do something like, if this happens, if something like positive or negative happens, then what we will do, that would be planned beforehand. So all these things that comes under the planning part, under the managerial accounting. Now if you talk about the implementations, so implementation is that carrying out the day-to-day activities and making short-term and long-term decisions, allocating the resources, directing and motivating people to execute the plan. So it means whatever that we have planned, then uh, those activities that we ascertained and strategies that we prepared, right? So that will be implemented in the day-to-day activities, right? So maybe the short-term or long-term decision, whatever it is, that we need to implement. For example, performing relevant cost analysis and cost volume of profit analysis that we do in the managerial accounting. So cost analysis, cost is a very important part in the manufacturing process as well. So what will be the cost of the product that we are producing? Take an example of a mouse. If that we are using mouse and we are producing mouse, right? So the manufacturing of the mouse and the cost of one unit means one mouse is just like a $3, right? So if we buy this mouse from the other parties, from the other companies, then what will be the cost for that, right? So if that cost is higher than this one, definitely we should manufacture that. Otherwise we no need to manufacture, we can buy from the other parties, from the other companies and manufacturers. Now, next is the control. So planning, then implementation and control. The control is also very important in managerial accounting. So control says that obtaining the feedback to ensure that the organization is moving towards the goal and objectives. So that is the controlling part. So feedback. So feedback is also very important, whether everything is going as per planned, everything is implemented as per plan, or is there any problem going on? Examples of managerial accounting in control. Preparing recurring or ad hoc when means when necessary accounting and performance report. Whenever there is some requirement, or uh, preparing the recurring means like frequently, right? So some of the accountings and some reports related to the performance report, if it is required, then that to be prepared and show to the top level management or the managers. So controlling here means some reports, performance report. What is the meaning of performance report? Performance report is related to, like for example, that in last month 100 were produced with all the machines, all the similar kind of number of hours and labors and techniques and the resources. But now that uh, 120 units are produced this month, it means the productivity has increased. It means good performance. Otherwise, if it is 80, then bad performance. Positive and negative performance that to be evaluated in the form of a chart. That is known as performance analysis and performance report that we prepare in a managerial accounting. This is what we have done, just planning, implementation, and control. Now, if we talk about managerial and financial accounting differences, managerial accounting is totally different from the financial accounting because the managerial accounting provide information for managers of an organization who direct and control its operations. But financial accounting that provide the information to the outsider parties such as the shareholder, creditors, and others who are the outside of the organization. Now, once again, that we can see the difference between financial and managerial accounting. If you talk about the users in the financial accounting, primarily externals are the users, maybe taxation department, Canada Revenue Agency here in Canada, income tax department in India, and other income tax authorities and department in other part of the world in different countries. So investors are also the external parties. Creditors are also the external parties and regulatory bodies. But in case of a managerial accounting, primarily internal to the organizations. Maybe managers, mostly the managers, right? Maybe production manager, then you can say accounting manager or the operational managers and the decision maker. Who is the decision maker? Maybe the owner or the senior managers or directors are the decision makers for what some particular things. So that accounting will definitely will help for the manager, helpful for the managers for taking decisions. If you talk about the time horizon, it's a historical perspective. Financial accounting is historical. Historical, if we talk about like, so whatever that we have done, that we need to evaluate. For example, uh, today is like it's a January is going on, right? And the last year, 2022, from the January till 31st of December, 1 year, 12 months period, that data related to the 12 months period, sales, purchase, expenses related to the 12 months period, that to be evaluated, that you need to calculate. It means you need to create trading and profit and loss account and balance sheet, cash flow statement, and owner's equity statement, means financial statement on the basis of the data, the things which I have already done, past data, past information. That is a historical perspective. Perspective means a viewpoint. Now, but in case of managerial accounting, it's different. It's the historical as well as the future perspective. So why there is a future perspective as well as the historical? The historical means the data which is already done, maybe the previous month or previous year or previous quarter, 6 months before report. On the basis of that, we will take that data and then make a base and a benchmark for that, and for the future that we will take that kind of things. I mean to say, if there is some expenditure on the sales, if like a 10% expenditure on the sale, maybe any expenditure, maybe indirect expenses or direct expenses, or maybe other expenses, on the basis of that we calculate that these are the expenditure on the regular basis, that we take the 10% expenditure on this particular things or process, right? So that is the historical and future perspective. If you say, then what we want to achieve, why that we just we need to know about what will be the cost of the product, that is for the future. Because some maybe for example that one project has come, on the basis of that project that we are going to produce some let's say keyboard or mouse, and the previous month there was the mouse and the keyboard that were produced and this much was the expenditure. So last time we saw that the mouse, the cost of the mouse, right? So cost of per unit was, let's say, the $3 or $4. So as per the data, as per the expenditure which is already done, already incurred in the organization, take the benchmark and use that percentage for the future perspective. And the next is the verifiability versus the relevance. Financial accounting that is totally based upon emphasis on the verifiable. So verify of data means the invoices, the sales and the purchases and inventories, that the stock that you have, you need to verify. Yeah, on the basis of the transactions. So maybe in the computerized form or maybe in the form of like manual accounting. You need to see all these information. And managerial accounting is emphasized on the or the relevance. So whether this cost is relevant, this method is relevant, this process is relevant for this or not, that you need to see. Precision versus the timeliness. Precision means like if we talk about the accuracy. So financial accounting that is focused on the accuracy, and the managerial accounting is that is emphasis on the timeliness. Unit of analysis, that will be entire organization in financial accounting, but in case of managerial accounting, that is individual organizational units, maybe a production department, sales department, or maybe distribution department, or the organization if it is required. Regulation, if we talk about, must follow the prescribed accounting standard, maybe international financial reporting system. And but in this case, like in a managerial accounting, no prescribed standard or prescribed format is available, but extent of the detail decided by the management. A requirement is financial accounting is a mandatory, like so. Uh, this is compulsory for the public companies to publish their financial statement in their website, also at the stock exchange. But for the managerial accounting, it is not necessary that what will be the cost, what will be the method. There is no any requirement as such. Now, uh, for if we talk about for the managers, so manager emphasizes on the future, maybe the relevance of data. So planning is a very important and a critical part of managing. So managing of what means, the first if we talk about, if emphasize on the future, right? Relevance of data mean data that that is appropriate for the decision at hand. Then emphasize on timeliness. So when information is required, a reasonable estimate is better than missing an opportunity. So waiting for more accurate information at the proper time, if the information is required and not available, that will be wrong in the business part. So now the focus on the segment. Planning and decision often occur throughout an organization, maybe from the small part to the big decision. Regulations, internal reporting guided primarily by benefits from using the info outweighing the cost to obtain it. So what is the meaning of this? Means the regulations, the rules and regulations are there. Whatever the internal reporting system is there, definitely that will be guided mainly by the benefits from the using the information. What will the use of that information? How you that you will be able to extract the important data, which is very important for the cost to obtain it, and how we can determine what is the cost of the unit, and what are the things which is not mandatory. The simple questions that become, is having the information useful, right? Some of the things may be useful, some of the information may not be useful. It depends upon the manager to manager, and also it depends upon the what kind of a procedure and process that we are following. Now, reasons for increased relevance and importance of managerial accounting. Now, if you talk about the managerial accounting, why managerial accounting is important? What are the benefits of managerial accounting? Why managerial accounting is used? Right? So the answer is that is to expanded competitive boundaries, globalization. It means we know that the globalization means the whole world is one village. One country can buy and sell, import and export a product and services from one part of the world to the another part of the world, from the one country to another country, from one country to another country. So some managerial accounting is also required for taking decisions. So whether to import the product or whether to not to import the product or manufacture here in the local market. So all depends and on the data that to be analyzed and evaluated. Higher expectations of business to be ethically and environmentally and socially responsible. So in the managerial accounting, expectation of the business. Definitely the business that should be done ethically, the business that should be environmentally friendly. So the things that you produce today, if that is going to harm the environment, but no doubt the cost will be less, that is not right. So expectation related to the socially responsible, that you should be responsible towards the general public, the humans in the society. Now, if we talk about the lean business model, this is the lean business model that we are going to discuss today. Uh, the main idea underlying this model is to reduce, right? To reduce what that to reduce and eliminate the waste. If there is a waste, then the main purpose is to reduce the waste. This is a lean business model. This is a lean business model that we will discuss. So companies incorporate practices with this goal in mind. So if you talk about this goal in mind, means like eliminating waste. That is the goal in the mind of the company. Next, we have consumers no longer accept that the cost of waste are passed on to them in the price they pay. So what is the meaning of this? It means no consumer want that the cost of waste, right? If the cost of any product has increased by their negligence, and then what happened, that cost of product is increased from a $3 to the $5 for a mouse that was produced. So the burden that will be on the customer. So the customer don't want to accept cost of waste. That will be the burden on them in the price, in the form of a price. Definitely they will pay, or in the time they wait. So why they should wait? So unnecessary the waiting time, that will be uh, eliminated, that will be reduced. Not only the cost but also the time that should be saved, right? For the product and for the services both, not only the product and services both, to be that delivered to the clients. So these are the practices. So these are the practices that will be included in the lean model, lean business model. The first one is the just in time, and second one is the total quality management. The third one is the process re-engineering, and the next one is theory of constraints. Now, if we talk about the first one is the just in a time, JIT. So in this case, just in time means I can give you one example of a Walmart. Walmart use a just in time strategy. For example, they saw and they have a very good experience in that. If, for example, the milk bottles, they have purchased from the maybe Dairyland, right? Then let's say maybe 500 units in a day. Let's for example, and they have maybe at the end of the day maybe 5 or 10 or something. Then automatically they will see the reorder point. So just in time, this is one example. Second, if in case of a manufacturing company, they just mm, want to produce something according to the order. Let's say I'm in the manufacturing company and I'm a manager there. I received one order to produce 100 mouse and 100 keyboard set, just a wireless keyboard and mouse kit, and with the packaging and everything. So if I have received that order, so I will start buying the product, means buying the raw material, then convert into finished goods. So that is the just in time process. So first is the receive customer orders. Once the order is received, then schedule the production. So this production will be scheduled, then receive material just in time for the production, then complete parts just in time for assembling into the product. It means assembling into the finished product that we talk about. This is just in time, and complete the product just in time to ship to the customer. So in just in time process, everything that is to be done instantaneously with a specific period of time, within a short period of time as required or demanded. Now, what are the benefits? Benefits of a just-in-time systems are reduce inventory cost. So if inventory is produced, right? So why to keep that inventory in the store, and why to pay the rent of the store every month unnecessarily? I can give one example. Structube is one of the furniture company here in Canada. It has a number of branches in Surrey, Coquitlam, Langley, and Richmond. I have been to all um, these furniture store last year, that when I just wanted to buy some furniture for my home, just like dining tables, chairs, a bench, and one couch, like one couch that I would just wanted to buy. What I did, that when I went there, I saw there was some stocks were available as per the requirement and demand. You need to place an order. So once you place an order, let's say, for example, I placed that order online, and I want this kind of dining table. Okay, so dining table is not there, right? So dining table manufacturing company is in Alberta. So all the furniture that comes from Alberta. So I placed that order. They say it will take around 25 days. So not only me that I have ordered for that particular product, there may be number of people around this, like maybe British Columbia, in the British Columbia, in all the cities, then they will be placing some orders for that particular item, that particular color, right? So in this case, what will happen, once the manufacturing company, which is in Alberta, I'm talking about the structure, they will receive entire order, and they will see 5 units of this, 20 units of dining table, and these kind of chairs, like the 30 pieces, these kind of like a couch set or maybe love seat that we want, right, to manufacture. They just place that order in a particular production department or a store, and then they buy some material, and that they start. So that is what, that is just in time system. So that reduces the inventory cost. First of all, this is the benefit. I gave you one very good example for you. Less warehouse space needed. It's obvious, right? No doubt, some of the articles that will be there in the store, and sometimes it is selling very quickly. Then why to occupy the warehouse for those items which are not in a demand? Higher quality products. So the fresh quality, like if that you have stored some of the article that will be stored in the warehouse for a long period of time, maybe for a year or a 6 months. So why to keep that stock? The quality will go down automatically with the weather constraints and the wear and tear, and maybe moving from one part to another part. And more rapid response to the customer order. Yes, a quick response. Yes, that you want this one, that we will provide you in short period of time, maybe 20 days or 25 days, as per the requirement. And greater customer, once the customer have a very good quality, the cost is really good, and if there is the more cost, that will be added in the cost of the product. So in a nutshell, that we can see the greater customer satisfaction, that will be the benefit of the just-in-time system. Now, the second is total quality management. If we talk about what is the total quality management, right? The total quality management, TQM, you can see that the plan, do, check, act, cycle. So what is the meaning of this? It means So plan, do, check, act. So these are the four points here. So first one is that we can start from the plan. That the study the current process. What is the current process? Manufacturing process. Collect the data, analyze the data to identify the possible causes, develop a plan for improvement, and decide how to measure the improvement. That is very important. Then once the data is collected, right, then we are going to do something. That the planning part is done. The once the planning part is done, then implementation part means to do means like implement whatever that we have planned on the small scale if possible, then collect the information. So once we have started some activities and collected some data, then why we have collected the data? To evaluate something, to check something, to evaluate the data collected during the do phase. Then did the expected improvement occur? So whatever that we plan accordingly, it was done or not, that is the checking part. Once everything is done, now the result is ready. So if the result are successful, make the change permanent. So whatever that is required, that was expected, the result is according to our expectations. So when the result is according to expectations, then make that process permanent. It means that was the right process, the best quality product has been produced during that particular process that followed during the entire from the raw material to the finished goods. If the result are not successful, try again this. So this is the TQM. It's a total quality management. So do, plan, do, check, and act. Now, so next is we have a process re-engineering part one. So in the process re-engineering part one, the one is here. We can say the business process is diagrammed in detail. What will be the business process that to be prepared in detail? Then every step in the business process must be justified. This process that we have followed, because of this we need to justify what the reason that we have followed this thing. That justification that should be done. Then the process is redesigned to include only those steps that make our process more valuable. So number of steps are there: 1, 2, 3, 4, 5, 6, 7, 8. Let's say there are 8 steps in manufacturing for the one unit. Now, if we see that if that step is not required, is not valuable, if we eliminate that step, then in a short period of time that we can produce more quantity and the same quality of products. So that process is redesigned to include only those steps that make our product more valuable. Rest of the product, that to be eliminated, that should be reduced. So this is known as engineering, which is re-engineering process. This is the part one. Now, so next re-engineering process part two is saying the process is redesigned to include only those steps that make our product more valuable. It means anticipated result process is simplified. If there is some process in the manufacturing unit, if it is so complicated and again there is a repetition of something, so reduce that. So that step should be simplified first. Then once the process is completed in a less time, definitely the cost are reduced, right? And opportunities for error are reduced as well. Now, next is the theory of constraints. Constraints are the some conditions. If we talk about the constraint, it means the restrictions or the barrier that impede means the delay, impede the process towards an objective. So it means those are the restrictions, those are the barriers, those are the constraints. Because of those errors, because of those barriers and restrictions and constraints, the process is totally delayed. It should be completed in 10 days and now it is completed in why 13 days. What's the reason behind it? So this is the theory of constraints that we need to see the why, answer of why. So theory of constraints, it means that this is a sequential process, mean continuous process, a step-by-step process, which is for what? This is for identifying and removing constraints in the system. First of all, we need to identify that, to find that, and after that we need to remove all those conditions, all those constraints, or the problems or errors in the system. That is known as theory of constraints, which is clear from the names itself. Okay, so theory of constraints, that these are the steps that we have just discussed. Identify the constraints. So first of all, the weakest link. What is the weakest link here, right? Then limit the strain on the process. Limit means to reduce the strain. Strain means the pressure on the process. Process means the system, that is from the raw material, buying from the raw material till the finished goods and packaging, and the end to distributing to the stores, right? So where the customer can come and buy, or then the product can be delivered to the customer to the capacity of the constraint. I mean, focus on the strengthening the weakest link. What is the weakest link? What is the weakest points? So that is also to be covered under the TOC. TO is theory of constraints, that focuses improving the efforts on objective and achievement barriers. Now, importance of ethical responsibility and corporate governance. So ethical. So all the process that should be done ethically good, right? No quality compromise. There should not be any harm to the people that we definitely use that product, right? So there should be proper ethical practices that build trust and promote the productive relationship with the client companies. Unethical behavior is often the result of managers focusing on the short-term result at any cost. They are not considering about what is happening there, right? In the short term, they want to earn a lot of profit. So that is unethical behavior that will be uh, the dreadful and not useful for the long term. To stop this unethical behavior, companies and professional organizations have written the codes of conduct. The codes of certain rules and regulation that which serve as a guideline for the members of their profession. There are the rules, there are the code of conducts that will be definitely written on the wallpaper, on the wall, maybe one board where the code of conducts are there. These things that you should follow, these things that you should not follow, means to-do list and to not to-do list in the manufacturing unit in the factory. Corporate governance enhances the stakeholders' confidence that the organization is being managed in their best interest. So the organization that each and every process is totally controlled and managed in their best interest, not only in the interest of the top management, but also in the interest of the shareholders and stakeholders and outsider parties as well. Now, what are the difficulties or implications in changing business environment or managerial accounting? So system designed in the early 90s no longer line up and support organizations planning, implementation, and control activities in the ever-changing business environment was there, right? So manager must question the usefulness of their existing managerial accounting practices and replace obsolete tools and techniques with the more relevant ones. It means if there is some machineries are there which is obsolete in nature, which is no use again, if those tools they are using again and again in the same company, definitely that will be drastically result in poor quality of the product, and maybe some problem or the damages can occur during the process, not only to the product or machinery, but to the manpower as well. So now what we say, the whole chapter, the chapter is saying that managerial accounting that provide the information to managers to make a better informed decision to help the company fulfill their mission and achieve its objectives. So business have incorporated lean business practices to respond to the increased competition due to the globalization. Organizations have implemented a formal ethical codes of conduct to promote all employees to behave in an ethical manner.